Imagine funding your early retirement without selling a single share from your portfolio. And now imagine passing that free ride down to your children one day. Well, that's DIY investor Ian Lopuch's dividend dream, and he says he's well on his way to reaching it. So if that dream is one that you'd sign up for too, don't go anywhere. We're about to hear this dividend maven's secrets to spotting stocks with staying power. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise, and I'm excited to welcome one of the OGs of dividend investing on YouTube. He's been sharing his insights for over 15 years on the platform, and he's helped countless investors along the way find their road to financial freedom. So let's bring him in. Joining us is Ian Lopuch, founder of the YouTube channel PPC Ian. Ian, it's wonderful to have you with us. We appreciate you taking the time to chat.
Thank you, Rob. It is such an honor to be here with all of you today.
Oh, thank you for the kind words. And Ian, I've been following your channel for a while, but when I saw you speak at a Toronto event a few months back, I said, I got to get this guy on the show. And we do it at a time when you're approaching a pretty incredible milestone, just 6 years or so away from financial freedom. So congratulations to you, of course. It takes a ton of dedication to pursue such an ambitious goal and then to ultimately reach it. I'm curious what's driving you towards financial independence, retirement early. Like, what is it that's pushing you to this milestone?
You know, Rob, there are many factors. I would say one of them is just I have been working in corporate America for many years. I am one of the US-based guests here on the show today. And over my career, what I have learned is I can only work at the pace that I am working for so many years. The long hours, I love it, but it can be really trying on just overall on your body, on your health, on just your stamina. And there's just so much more to life. I have 2 beautiful kids, an amazing wife. We love to travel. And so I've always been interested in finding a solution where I can retire a bit early and travel the world more, enjoy life more, spend more time with the family. And of course, I must say I love what I do. I'm very happy in my role right now. But of course, having just some flexibility in life is really, really nice.
Yeah, it's interesting. A similar sentiment that I've heard from others pursuing FIRE, as it's called. You don't actually want to retire from your job. You like what you do. You just want more control over your time. And you'll have many more travels, I'm sure, in the near future if you're able to reach your goals. So dividend growth investing, of course, is the strategy that you pursue. And you credit it for a lot of your success, obviously, so far. For those who are uninitiated, how would you describe your strategy in a nutshell to someone hearing it for the first time?
That's right. So dividend growth investing, Rob, is the best way to explain it. I like to invest in those companies that are the best companies in our world. And those companies, they oftentimes pay a dividend and a growing one at that. And so I am not just investing in boring companies that are kind of steadily holding on there. No. I like to invest in those companies that are growing their businesses because I realize that if they grow the business, they can grow their revenue over time, their earnings, and ultimately pass some of that value along to shareholders like myself. And it's so nice to invest in dividend growth companies because I've come to expect dividend increases each year. And the types of companies that I like to invest in terms of full disclosure, I own these companies, but companies like McDonald's or Johnson & Johnson, these are the types of iconic companies that I don't have to worry about because a big part of my strategy as well is having something to pass on to our children, to our 2 kids. And I want those companies that have the staying power to be around for a very long amount of time into the future. But I must illustrate that I am a dividend growth investor. The types of stocks that I invest in, they don't oftentimes have a very high starting dividend yield. My portfolio average, it's about 3.6%. And a lot of income-oriented investors, they might look at that and say, hey, Ian, that's kind of low. And it's true, the starting yield, it's not very high, but where I see a lot of gains is through dividend growth and this concept of yield on cost. I think the best example I could just give on that really quickly is I own a stock, Altria. I bought it back in 2009. Now, every year on the original investment that I made, I'm yielding in terms of dividends 26.5%. And the reason for that is they've increased the dividend over the years.
Okay, so these are oftentimes brands that people are very familiar with, that they know that they've been around for a long time. They have a long track record of success. But that said, there's a big universe of potential dividend stocks you could choose from. So let's get to the heart of our conversation, that being your top tips to help supercharge the growth of a dividend stock portfolio. Maybe pick some of those ones that have a lot of potential. Of course, if you're in the audience and you have some questions for Ian, we'd love to hear them. So make sure you submit them to us. If you're watching on Webroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, it's the questions and comments box. And if you're watching on our YouTube live stream, there's a link in the description that you can follow that will take you over to our broadcast platform, and that's where you can ask your question. Make sure you get them in. Okay, Ian, your first tip that we're going to talk about for supercharging the growth of a dividend growth portfolio is to invest in the highest quality dividend stocks. Of course, that can mean a lot of things to a lot of people, but give us a sense of how has focusing on quality like that helped you grow your portfolio over time?
Quality is so important because the value in the system that I employ for my dividend growth investing really revolves around time. The more years that I have in a stock, the more years that it can compound that dividend over time, the more dividend cash flow I can receive. Because for myself, I'm really looking at dividend yield on cost. And so I tend to invest really in those iconic brands. You've probably heard of most of them. And really where I like to start with my investing is, have I heard of this company before? It's as simple as that. It's some of these classic Warren Buffett and Peter Lynch style investing philosophies where, hey, is it in my cabinet at home? Do I frequent that restaurant? When I've been in the hospital, unfortunately, have these products come into use? Those types of very obvious companies. And then when I look at those companies, obviously, I really like to dig into the fundamentals and the financials. So I spend a lot of time looking at income statements, balance sheets, statements of cash flow. I like to look at their annual reports, their quarterly reports. I even read books about the stocks in which I invest. One company I own, Starbucks, I'm actually on my third book that I've read about that company. And so I just like to really get into it and educate myself and make sure that I'm buying those brands that have the staying power, not only to stay in business, but to grow their business over time. These are the types of companies that have competitive moats. These are the types of companies that in our modern world, where oftentimes it really can be a winner takes all world that we live in, these are the winners that are going to be very difficult for competitors to displace. Because even if there is a competitor, the types of companies I own, they'll probably just end up acquiring that competitor.
Yeah, and you have several criteria that you like to follow here. But that said, what are some of the ideal, I guess, features of a dividend growth stock in your view? Are there specific metrics that you're looking at and, rate of growth or appreciation in those metrics that you're really dialing in on?
Absolutely. And so the first metric I look at is revenue. I like companies that grow revenue around 7% per year or more. That's not always possible with some of the more old world companies that I invest in, like Johnson & Johnson, for example, or PepsiCo. But on some of the newer companies like Alphabet, this is a dividend growth stock right now. They pay a dividend. They've increased it already by 5%. They're growing the top line very rapidly. And so the first thing I look at, does this company have sustainable revenue growth? I also like to look at margins. The best companies in the world, they're going to have very solid gross margins, operating margins, net margins. I like those companies that are very efficient at converting revenue into earnings. And so margins are very important to me. High margins are indicative that a company does have a competitive moat within its industry. I like to look at the balance sheet. I like to invest in companies that haven't taken on too much debt. Now, obviously, this is very specific to different industries. Certain industries like regulated electric utilities, they're going to have a lot of debt. It's just the nature of the very business that they're in. But other industries like software or internet companies, I like those companies that have next to no debt. And this is more important than ever right now in 2026 because interest rates are still a bit higher these days. And these companies, they have to refinance their debt from time to time. And when the debt comes up for refinancing, they're now refinancing at higher interest rates than just, say, 5 years ago. And so it's important that they're very sharp with managing their balance sheet. I like companies that have very strong statements of cash flows as well, because we'll probably talk about this later, but sometimes the net earnings, the earnings per share, they don't tell the whole story because there's hidden expenses that can show up on the statement of cash flows, such as capital expenditures. And I want to make sure that the companies I invest in have a lot of free cash flow and that free cash flow can pay for everything, including my dividends.
And of course, dividends is obviously a really important aspect of being a dividend growth investor too. There's often some debate as to like where that perfect sweet spot is between dividend yield today, dividend growth tomorrow. How do you thread that needle? What are you looking for?
This is such a good question. And I think in the world of dividend investing, there's a lot of confusion right now because a lot of people, they look at dividend investors and I think they assume that most of us are investing for 10% yields. And there are a lot of dividend investors right now that are investing in stocks or ETFs that have very high yields, and it makes sense for their personal situations because we're all different. But being someone who is a little bit more conservative on risk and someone also who has a few more years. Look, I'm about 6 years away from hitting my financial goals, but even after that, I want the portfolio to grow. I want the cash flow to grow. I want it to grow not only for myself, and my wife, but for future generations as well. And so for me, I've found, given what I'm trying to accomplish with not only my personal life, but future generations, and with my risk tolerance, that my sweet spot is really where the portfolio is. And that's about 3.6% current yield. And I'm trying to grow my dividend cash flow over time. Actually, these days, I'm trying to grow my dividend cash flow by about 12% per year. Now, some of that is coming from dividend reinvestment. Some of it is coming from company dividend increases. The companies I own, they tend to increase their dividends each year. Some of that is still coming from net new capital as well. So I'm infusing new capital into the portfolio to help drive that 12% dividend growth year after year after year.
Okay, so that's your answer to the contentious balance between yield and growth. Okay, thank you for sharing that. Let's get to your second tip now, and that is to hold a diversified portfolio of dividend stocks to the point where, Ian, you're holding more than 40 dividend stocks and ETFs, which could be a lot, I think, to a lot of people. I've heard others closer to 20, 25, maybe 30 on the high end. You're blowing way past that. But how has casting that wide net helped you supercharge your portfolio growth in your view?
So in my opinion, we live in a very different world right now in 2026 than we did, say, in 2018 or 2019. I really look at the pandemic as kind of a shift in where just the risk factors in our world went. And I see more risk these days than I did in the earlier days when I was investing, especially when I was buying Altria stock back in 2009, and I was buying other stocks like Johnson & Johnson back in 2011. There wasn't quite, in my opinion at least, the level of risk in the world then that there is now. And so how I have diversified my portfolio is I have bought 44 at this point ETFs and stocks. And the reason I've done that is to really shelter myself from single company risk. Because what I found in 2026 and in recent years is things just happen in our world. And there are risk factors that could possibly cut a single company in half. And so I don't want any single company in my portfolio to have risk that would take away from my goals of reaching financial freedom. So I've solved this problem by having 44 positions. Now, I must say, and this is very, very important for the viewers to understand, I have about 62% of my money in my top 10 positions. And so I do weight very heavily towards my best investment ideas, although my portfolio has what I would like to call a long tail. There's a long tail of stocks, and some of them are very small. They're only, say, 0.5% in the portfolio weighting, but they all play a role. Now, one of the reasons as well that I diversify, I must say, is I like to collect stocks. This is a passion of mine, and I'm always finding amazing businesses that I just want to own. And so that's part of it as well. And I think it's okay to do that because it keeps me motivated. It keeps me in the game. And that's one of the most important things as an investor, is just to stay committed to a strategy. And so the last thing I would say, though, on my diversification is because I have so many positions, it gives me a little flexibility, especially on the smaller positions, maybe to take on just a little bit more risk, but in a calculated way with smaller positions.
Okay, you just got to make sure that you don't get into Pokemon territory where you got to catch them all, right? You still do have to keep that portfolio down. Keep it under 50 or something like that, right? But in any case, I appreciate the I guess, commitment to diversification, what's been called the only free lunch in investing in a lot of respects. Seems like you're a big believer in that. Let's move along to your third tip, because this is a good one. And this is buying high-quality dividends growth stocks that have experienced at least what you feel is a temporary drop in stock price. This value angle is a big part of your strategy as well, I know. So talk us through how this bargain hunting has really helped you accelerate the growth of your portfolio.
I'm really glad you asked this question, Rob, because it's timely as a follow-up to the last question. One of the reasons I actually hold so many positions is exactly what you just said. When I go shopping these days, and when I mean shopping, buying dividend stocks or ETFs, I start with the stocks and ETFs that I already own. Because I own 44 positions in total, and these are all high-quality ETFs and stocks, usually there's at least one or two of them on sale. And this is a hallmark of my strategy, because growth from a portfolio, and dividend yield for that matter, it not only comes from those metrics we discussed earlier. We talked about revenue growth, earnings growth, dividend growth that can be passed along to shareholders. All of that is the basis of my strategy, but I can supercharge all of that when I buy a stock on discount, because when a stock or ETF is trading on discount, the starting dividend yield is higher. There's an inverse relationship between the dividend yield and the stock price. As a dividend investor, I rejoice when I see the stock market falling, or when I see particular stocks I want to buy falling. And so also, though, just from a total returns perspective, because I don't want to kid myself, my portfolio, I don't plan to sell my positions, but I value the total returns and I value the capital appreciation. Stock like Walmart, which I own, I'm now up over 600% on the original shares that I bought. And that matters because it gives me flexibility in life. I'm sure we'll get to that later. But what I'd like to say about value investing is it's very important that I'm not only a dividend growth investor, but I overlay value investing on that. And what I like to do is look for iconic companies that have faced a temporary period of distress. A perfect example of this might be IBM, which is another company I own. And so IBM, a number of years ago, it was facing a lot of distress. They were having management challenges. This was an iconic brand that had already reinvented itself so many times over the decades. It had a great starting yield. I think when I bought it, the PE ratio, price earnings multiple, it was really low. It was like 10 or 11, somewhere down there if I remember. It was very low. And I knew, hey, they have a problem. Revenue, earnings growth is stagnating, but cash flow is still really good. The dividend is covered. They're going to figure it out. And so I spent a number of years accumulating IBM. It went nowhere. Then all of a sudden, they acquired Red Hat, and the rest is history. After that Red Hat acquisition, they brought in Red Hat's president and CEO as the CEO of all of IBM, and the rest is history. The stock has recovered. They are on a growth trajectory. They have plans for the future. They're doing really well with AI. And I imagine over the coming years, the dividend, it will probably continue to increase. And so the key and the hallmark of my strategy is I love to look for those temporary buying opportunities. Sometimes they're very short-lived, and especially in stocks that are covered by a lot of analysts. Last year, in 2025, earlier in the year, Alphabet stock was on sale. I went really fast buying it because that buying opportunity, it only lasted maybe 6 months in total. And now Alphabet stock is up. It's up about 80% or so from that time period, just in under a year. And so sometimes with stocks, that opportunity to buy when they're trading on discount can be very short-lived in the case of Alphabet, especially because so many analysts follow the stock. But in other cases, like with IBM, hey, it can last a few years. And so you also have to be very, very patient with that strategy.
Now, obviously, this is a little bit of a case-by-case basis type kind of thing, but it's really hard to kind of determine in a lot of cases when a stock is down for a temporary reason versus, a more permanent reason. What are some of the clues that you look for that help you understand whether it's temporary or not?
Rob, this is where the diversification comes back. It's, I would say, a difficult analysis to make. Oftentimes, it's very case by case. I'll give you another example. So one of the stocks I'm very well known for on YouTube because I covered it very excessively a number of years ago. It's called AbbVie. And so AbbVie was taking a very difficult number of years there because their blockbuster drug Humira was going off of patent protection. And everyone could see, hey, this is going to affect their cash flows. It's going to affect their ability over time to grow their dividend. At that time, I started building my position in AbbVie because it has such a strong record of doing very well over the years. And I got a little lucky. Basically, AbbVie ended up merging with Allergan and the maker of Botox. And as part of that merger, it reinvigorated the growth of the company. There were some other wildcard factors that played out in their favor. They have new blockbuster drugs that have come to fruition to replace Humira in terms of the company's sales and earnings and have supercharged their growth. And so the reason I use this case is sometimes it's a matter of diversification. It's a matter of taking conscious risk. And it's being like, hey, Ian, yes, you don't know what the solution is to this problem. You have a hypothesis that they're going to find a solution, but you don't always know what it is. And you can buy this stock, but you don't want to over allocate to it. You want to stay diversified. And that would be, I would say, a very good example of just taking on conscious risk. Oftentimes that is what it looks like when I am buying value. A perfect example right now that's happening in front of us is Kimberly-Clark. This is a company now that is in process of buying/merging with Kenvue, which is a spinoff from Johnson & Johnson, the maker of Tylenol. And Wall Street so far doesn't seem to like the deal because the stocks are, Kimberly-Clark stock has traded down. Now, I don't know how this is going to play out. The merger may happen, it may not happen. We'll see if it gets approved. Will the merger be successful? I don't know. When you're in the thick of it, you don't always know how it's going to play out. And so what I do is I just go back to basics. Ian, you've owned Kimberly-Clark for how many years? A lot. You know the fundamentals of the business. You look at the financials. There's a propensity that they're going to be able to continue to pay that dividend. They have appointed very smart management in place to figure things out for you as the shareholder. This is fundamentally why I love dividends so much. It's true passive income for me. I don't have to worry about the company. I don't have to make these difficult business decisions. I don't have to figure out this mega merger. I'm going to let the experts do that for me as a shareholder. I can watch them do it. But in the middle of it, I don't really have a secret sauce other than diversification, experience. I've been in the game a very long time. I've been investing in dividends and I've been investing with this style for a long enough time where it is a bit of intuition and I diversify. Now, there are certain cases where a company may have a knockout punch. Those are very rare. And in those cases, I will stay away. Usually it's a catastrophic change to their fundamentals where there was some kind of force of nature or act of just kind of nature or just the political structure, global dynamics that have made their business in such a way where it will not recover. And so I spend a lot of time reading the news and understanding if a company is in that kind of position, I'll stay away.
And that situation that you're describing is what some might call like a value trap to some degree. That's the fourth tip on your list. Can you maybe share an example with us of a stock that you invested in? It turned out to be a value trap. You missed it on that one, but that you learned something important from that maybe others can take forward?
Absolutely. And so one of the things I want to emphasize for everyone watching today is no investor is perfect. All of us in our portfolios are going to have blockbuster winners. I've had a few of those, and I'm very proud of them. We're also going to have stocks and ETFs that just kind of hold the line. They're going to be performing just kind of steady state, maybe slow growth. They're doing okay, good enough. And then we are going to have a few losers in the portfolio. And we're going to learn over time. As we invest for more years and more decades, we're going to keep learning and refining the process. One stock that I remember that fooled me a bit was Leggett & Platt. I ended up selling this one. And Leggett & Platt is a company that used to be a dividend king. Dividend king, you might have heard of this term, is a company that is a member of the S&P 500, and I think there's also minimums on how much revenue they're driving. They have increased the dividend consecutively for 50 years or more. And so dividend kings are a very, very special subset of stocks. And you were asking me earlier, Ian, where do you source your best investment ideas? Well, hey, the Dividend Kings list is a great place to start. But anyway, Leggett & Platt, it was a dividend king. And unfortunately, over the years, their business unraveled a bit. Now, and they had to end up cutting the dividend. And I would say the lesson I learned from that company is diversification. It's also making kind of a wise understanding that just because something has done well in the past, just because something is a dividend king, does not mean that it will always be so in the future. And so when I'm investing, it's very important for me not just to only look at the past, but to understand where is this company going? And not only where is this company going, where is our world going? Is the world going to leave this behind? And so that was an example of a stock that I ended up selling. And it was one of those where I think a lot of investors felt like it was going to be a dividend king forever. And it was not. They make white labeled furniture and springs and specialty springs, I think, for the aerospace industry as well. My best thesis of what ended up happening with that company was just global geopolitics. A lot of their business ended up getting disintermediated, most likely by just global competition. And so I think that's something to look at as well, is who are the competitors out there, and what are their costs of production, and how are things trending in our world. But it's very important. You mentioned the word yield trap. As a dividend investor, it's very important to look out for dividend stocks that might cut their dividend. Oftentimes, these are the stocks that have a very high starting yield. Not always, but oftentimes maybe the starting yield is 8%, 9%, and they have a likelihood that they could possibly cut that dividend. That's the worst thing for a dividend investor, because after all, I invest for cash flow. I don't want to take a pay cut. I want pay increases over time.
Yeah, I mean, that's a tough example, Leg, because on paper, on the surface, it looked great, but it was kind of a matter of digging deeper into the fundamentals of the business model, and obviously doing some projecting into the future to see if it could ultimately sustain it. Unfortunately, it was not able to, but hey, at least you walked away with a lesson. Let's get to your fifth and final tip, and this one is to continue holding stocks through the ups and downs of a business cycle. How do you feel that sticking through a disappointing period with a stock can eventually pay off, even if it does something pretty radical, a dividend investor's nightmare scenario, let's say, and something like cut a dividend?
Rob, this is another good question, and I'm going to answer it with some knowledge I just acquired. I'm reading a book right now by Howard Schultz called Onward, and it is the book that he wrote when he was brought back as the CEO of Starbucks in around 2008, 2009, when the company was facing challenges. And so I looked back in time at Starbucks stock. This is another position I own, and they're going through a turnaround right now with their new CEO, Brian Niccol. But if we go back in time to 2006 to 2009, the stock dropped all the way from $18 per share down to the mid $4 range. And that's the point where Howard Schultz ended up coming back into the company and turning the company around. I think in that period, they faced a number of challenges. Some of them were self-inflicted challenges. Some of them were just macroeconomic. Obviously, during the great financial crisis era, the consumer was strained and they were being very careful about how they spent their money. Nonetheless, what this example tells me is it would be so frustrating. Imagine back then, just put yourself in the shoes of an investor who ended up selling this stock, say at $4 or $6 or even $10, when we fast forward to today and it's at around $95 or so in 2026. It would have been really a frustrating experience, but that's okay. If that is you and you're watching, don't worry. This is how we learn in investing. I've learned the same way, through trial and error and having setbacks and using those as lessons to learn. That's the best way to invest and to learn. But what I've learned through that book and just through my own experience is every business, every great business goes through business cycles. Business growth is not linear. We would love for it to be, but that's why there is a reward for investing in the stock market. The reason stocks have done so well over the years is there is that added level of risk, and that added level of risk is businesses, they are living and breathing and operating companies. We're not investing in stocks here, we're investing in companies. And all companies face periods of challenge or just periods of stagnation. And so as a long-term investor, what I have learned is to be very patient, very, very, very patient. I'll give another example. When I first bought Walmart, it had traded flat for a number of years. It went nowhere. And back then, the dividend, it wasn't very high. It's never been that high for Walmart, but it was maybe a 2% range, 2.5%. I just stuck through it. Fast forward to today, I'm up over 600% on that because all of the gains came at once. Another example, Johnson & Johnson. Over the last 5 years, it was flat for a big portion of the time. Then in late 25, early 26, it started skyrocketing. And so there's kind of two concepts here. One, it's really important to remember business growth is not linear. We have to be patient as long-term investors. It's very important that all of us perform our own research. Of course, everything I'm sharing today, it's not investment advice, just my personal journey. It's very important to remember, though, to perform your own research because that's how you have conviction to stick through those years where a stock may go sideways or even down, like Starbucks did in 2006 to 2009. The other thing, though, that I would say is a business fundamentals, they're not always directly correlated to stock price. And so this is also why I invest for dividends. I don't have to worry about stock price as much. I know it'll work out in the long run. But with the case of Johnson & Johnson, you would think, hey, it would just go up and to the right a little bit each year. That wasn't the case. Last few years, it's been pretty flat. Then all of a sudden, it is catapulted in share price. It's just how the market recognizes value. And it's important to be very, very patient. If you think a stock is undervalued, that undervalued level, it can last for a long time, or it can be very quick, like in the case of Alphabet, where the stock market's like, nope, that's undervalued. We're going to bring it up to fair value right away. And so it's just a very interesting game. But what I have learned is a lot of patience, dedication, investing in companies, not stocks. I'm buying companies for the long term.
That's a good way to look at it, Ian. And if I could just quickly get your take on something really contentious, that dividend cut issue. If a company that you hold, that you otherwise like, cuts its dividend, do you sell it immediately or do you hold on?
I would say, Rob, I am loyal sometimes to a fault. And so I am one of the most loyal investors around. If a company cuts its dividend, I do not have a quick reaction to sell it. I like to give it some grace, give it some time to figure things out. Again, I'm investing in companies. I know companies don't have linear growth. If they faced a setback and I believe in management, I'm going to delegate that responsibility to them to figure it out. Now, sometimes if I think the dividend cut is irreversible, of course, I will probably consider moving on. But I want to give an example. During the pandemic, the price of oil plummeted. And at one point, I believe it was negative. This was very odd. At this time, many of the companies that I own in my portfolio in the energy sector ended up reducing their dividends, of course. And I realized during that time, am I just going to sell all of these? Will oil always be negative? Will it never come back in price ever again? I didn't think that would be the case. I had a feeling that at some point in the future, maybe it would be a year, maybe it would be 5 years, maybe 10 years, I don't know when, but that, hey, as humans, we need energy. The energy companies will come back because the price of oil will come back to a reasonable price, and that the dividends will resume, and not only resume, but grow into the future. And so that was a case where not only did I hold on to companies that cut their dividends, but I actually added some more. I ended up doubling down and buying more because I felt like the market had overreacted. And this is something also I'd like to impart to the viewers today, that what I have found is whether it's to the upside or even the downside, the pendulum will swing, and sometimes it overreacts on either way. And oftentimes when things get bad, stock prices can get a lot worse than it really is. And that was a case, I think, with the oil companies back during the pandemic.
Yeah, that was a very peculiar situation. Glad to get your take on dividend cut. That's a very difficult situation for any dividend investor to deal with. Appreciate your insight on that. We got our live viewer Q&A coming up in just a few minutes there. So if you haven't gotten your questions in for Ian, make sure you get them in. Check us out on social as well. We're on YouTube, Facebook, and Instagram. You can check out all of the great content that we have to help elevate your investing knowledge, as well as some sneak peeks at upcoming episodes that we have as well. First, though, I want to get to my colleague, Caitlin Cormier, because she is going to show us how to evaluate dividend stocks in WebBroker. Caitlin, welcome to the program. We're a little bit crunched for time, but I'm hoping that you can give us a quick walkthrough here. Ian and I were talking about some of the fundamental metrics that he likes to evaluate. So where can investors go find this stuff in WebBroker?
Yeah, absolutely. I just pulled one of the companies that we kind of mentioned through it. I know there were a lot of options, but I pulled up McDonald's here. So essentially within WebBroker, if we click on the research button, underneath investments and click on stocks, you can pull up any security you'd like over on the right-hand side. We're going to get to the overview page, and probably pretty self-explanatory. We're just going to go ahead and click on fundamentals. And this is where we're going to see some financial information for the companies. We've got some kind of metrics listed here against the industry average. We've also got a peer comparison where it's going to take that company versus the industry average and similar companies. And finally, the financial statements, both annualized and interim, that were mentioned, as well as another place to sort of understand the company in more depth and get sort of that second level look at what's happening with the money inside that company.
It's great to have that stuff all laid out there really quickly and easy to grab. So we appreciate you showing us that too. And another just quick thing that I'll throw out there too that we don't have time, unfortunately, to cover is the Analyst Center. You can go check out analyst research as well too, just by clicking on the Analyst tab. Caitlin, sorry to crunch you like that, but we appreciate you showing us the ropes so quickly. That's TD Direct Investing's Senior Client Education Instructor, Caitlin Cormier. All right, Ian, let's open the floodgates to all the questions that we have coming in for you. You're a popular guy. Let's see what our first question is for you to tackle. This is from Joe. Joe's asking, some stocks you mentioned pay such a small dividend that it's more of a growth stock, isn't it? How do you prioritize that?
This is a really good question, Joe. I love these kind of companies because they help offer growth in my portfolio. And so some examples that I own are Alphabet and also now Meta as well. And the starting yields are very low. They're lower than 1%, but they have a lot of room to grow their dividends over time. The way I look at it for my personal situation, not investment advice, is I'm building a portfolio not only for myself, but for future generations. And it's going to be very important, because we live in a world full of inflation, that the portfolio offers growth over time for the dividends and the portfolio value, because having a portfolio that has a lot of value, it gives me a contingency plan. I don't want to sell stocks, but if I have to, hey, it's nice to have a portfolio that goes up in value over time. The way I look at those stocks is they play a role in my portfolio. I don't want, for my personal situation, I'm in my 40s, I don't want to get too overweighted in the really low yielders, because the reality is I do need cash flow now, but I like to look at them as almost paired trades. If I'm going to buy a stock that offers a higher yield, in very low or kind of minimal dividend growth. I mentioned Kimberly-Clark earlier. That's a stock right now yielding around 5%, but I don't believe the dividend's probably going to grow too quickly over time, maybe somewhere between 1 and 3% per year on average, which may keep up with inflation just barely. If I want to supercharge my portfolio, oftentimes I look at paired trades. I'm like, hey, Ian, yes, you're going to buy some Kimberly-Clark, but let's also buy some Meta at the same time. And they don't have to be at parity, maybe 80% weighting Kimberly-Clark, 20% Meta. And I buy stocks like that because I can get everything I need. I can get the yield now, even on a blended basis, because the starting yield is so high on a Kimberly-Clark. And then I get the growth coming from Meta that Kimberly-Clark does not offer. But to answer your question, I do value those stocks. And I know a lot of dividend investors who that's what they primarily focus on, because I do believe that some of these low yielders, they're the great dividend growth stocks of the future. Great question.
Yeah, that's a really interesting way of looking at it, pairing things together like that. So appreciate that insight. Let's get to our next question here. This one coming to us from Lorana. Are stocks offering really high dividends doomed for failure?
That's a really good question as well, and it gets back to the question you mentioned earlier, Rob, about the concept of a yield trap. When a stock offers a very high dividend, I think it's important to remain extra cautious, and that's where, for my situation, I venture into them with a lot more research, a lot more caution. I'm very careful. Sometimes these stocks are able to maintain the dividend. I'll give an example. In late 2023, in December of that year, actually, I was able to acquire some more shares of Altria. It was trading down. It was on value. It goes back to that topic earlier we were discussing about buying great companies when they're facing temporary setbacks. Anyway, I locked in those shares, and if you fast forward to today, the stock has recovered quite a bit. On those particular shares, I'm actually up 53%, and the yield that I locked in was 10.5%. And so the reason I'm mentioning this is sometimes investors get very scared when the starting dividend yield is high. And it's good to be cautious, but it doesn't necessarily mean the dividend will be cut or it is a yield trap. It's really a case-by-case situation. So the Altria example was an example of one that had a high yield and it was not a yield trap, at least as of today. Things could always change in the future, but as of now, it's done quite well. But of course, when something has a high yield, I think it is important to be very cautious.
Yeah, a case-by-case basis, definitely the key takeaway there. Let's get to our next question. This one coming to us from Carmen. Carmen saying, what if I don't have a lot to invest? How can I profit from dividends?
This is a great question as well. I like to say that dividend investing is for everyone. And even if you don't have a lot to invest, everything can add up over time. And I would say the most important thing you may have going in your favor is time. Years and years and decades even in the market, they can work wonders. Look, I'm maybe about 6 years away here from reaching my goals, and that's really exciting for me, but I have been investing in these stocks for a very long time. Some of my earliest positions that have done really well are all the way back now from 2009. And I've been investing since even before then. And what I'm trying to say is those time in the market can really work wonders in terms of compounding, because over the years, as these companies increase their earnings, the share prices will go up. The dividends will be increased. The dividends that you reinvest back into the company, if you choose to do so, they can produce more shares of stock that also in turn pay dividends. And so there's this concept called the dividend snowball, which can really build over time. And all it really is just the miracle of compound interest, which is really a wonder in our world. And so I would say for someone even starting small, we've all started small, I would say. When I was starting investing, I was investing small amounts. And I at one point did an analysis of my portfolio. This was a number of years ago, but I looked at all the trades I'd ever done. And yeah, I'd made some really huge trades in my portfolio. But when I looked at most of them have just been kind of base hits, smaller trades. I'm always in the market. I'm making trades each week. They're just small amounts of money that have really added up over time. I would also say most dividend investors out there, once you get in the practice of buying dividend stocks and you see the income coming through and you really get into it, it's so motivating. And a lot of us, we end up finding ways to cut expenses and have more money to invest because it's that virtuous cycle. And it's so compelling to buy more shares that we end up finding ways to make those smaller amounts just a little bit bigger by cutting down on certain expenses in life.
Yeah, the psychological aspect to watching the dividends grow over time, particularly when that snowball starts rolling, is really powerful stuff, intoxicating even. So I totally appreciate that. Let's get to our next question. This one coming to us from Lewis. You mentioned that the dividend growth of the portfolio, or your portfolio, is about 12 or 13%. I'm interested in the dividend growth without the dividend reinvestment component. Any tips for Lewis here?
This is great. Yeah, I did an analysis on this in recently, within the last few months. I don't have it in front of me, so I can give the ballpark numbers. But basically, my goal is the 12% because I know I have to hit that 12 or even 13 to get to where I'm going. And I need to do that for at least about 6 years here, and then I can slow down. And so organically, I would say the portfolio right now, on a dividend growth basis, just the companies that I own, the ones I own, they're growing their dividends by, say, 5% or so per year, 5.5%. I think it's going to be more around 5%. So off the bat, I'm getting 5% growth just for doing nothing, even if I have all the dividends I receive and I spend them, because the companies I own in aggregate over the last 5 years, they tended to grow the dividends by about 5.5% per year. But again, I'm going to round down to say 5 because things are only going to slow, in my opinion, over time. It's just where I see things going. So I've got 5% covered. Then the portfolio, I have dividends coming through. I have about a 3.6% starting yield. Most of those dividends I am reinvesting, although some of them I am not. My income, I work in the real estate profession. It can be lumpy in certain months, and certain months I actually use dividends to help pay bills. So of that 3.6% that I have coming through from to possibly reinvest, let's just say I'm reinvesting about 3% of those, or 3%. The 0.6% I'm just spending on living expenses. So where that brings me is 5 plus 3, I'm getting up to 8. But I need to get to 12 or 13. So there's about 4 or 5% of my growth that's coming from net new capital. Now, that's becoming very difficult for me at this point because the portfolio is bigger. And as the portfolio gets bigger, and I'm kind of in these later stages of getting to my goals, I have to infuse it with more and more capital to bridge the gap between that 8% and the 12 or 13%. And that's kind of where I'm at. But if I think as a base case, I'm at 5% growth if I spend my dividends. As a base case, I'm say at about 8% if I don't put more capital in and I'm spending just a little bit of my dividends. And I can get to that 12 or 13% with net new capital being infused as well.
Okay, interesting study, crunching the numbers on your own portfolio there for some perspective. I think we have time for one more question. Let's bring this one up on the board. This one from Felix. Dividend growth investing is a long road. Is it too late to start investing when you are in your 50s?
Oh my gosh, this is a good question. It's a really long road. That is true. I like to call it get rich slowly. At least the strategy that I have, which is the classic DGI strategy, the high quality stocks that have lower yields. You're really waiting for delayed gratification. I would say for, again, not investment advice, just speaking to kind of my personal journey for fun and entertainment. But I would say it's never too late to start, in my opinion. I think the most important thing for investors is to take a step back and find a strategy that resonates with them, that they feel comfortable with. Because whether it's dividend investing, tech stock investing, mutual fund, ETF investing, index investing, just S&P 500, whatever strategy it is, it's never too late to get started. All of us these days are living longer due to medical innovations and the quality of life. And so we want to really plan for the long run. And we're not only planning for ourselves, in many cases like mine, I'm planning for the future of my family as well. One wild card that I want to bring up is just AI. We know that AI is coming our way. One of the reasons I think it's important to be not only a dividend investor, but just an investor in general right now, is there are some really disruptive trends happening that can be great for these companies. A lot of these companies are going to implement AI and it's going to increase earnings and it's going to provide a lot of opportunity. Conversely, there are some worries out there in the world about Not right now, but looking decades into the future, what does that mean for the future of jobs? And so as we plan ahead, not only for ourselves, but future generations of our family, or for people who don't have kids, maybe, maybe their nieces and nephews or others that they're looking out for, it's never too late to get started. I think it's really important in our modern world for people to be investors. And it's important to pick an investing strategy that matches your personal risk tolerance, your personal objectives, and you can remain committed to it as well. And so whether it's dividends or tech stocks or index investing, I think it's never too late to get started.
That's a great message to end things on. And of course, it's the consistency that's key over time. If you can stay dedicated, stay focused, something is better than nothing, of course, right? And your investments will hopefully grow over time. Ian, there's 1,000,001 other things I would love to ask you, and certainly our viewers would like to ask you as well, judging by the comment sheet that we have here. But unfortunately, time beats us. We'll have to have you back on the show to answer all this stuff and more. But thanks so much for taking the time to join us.
Thank you, Rob. This has been a real honor. I truly appreciate it. Thank you, everyone, for watching, and I'll see you all next time. It really is an honor. Thank you.
Appreciate the kind words. And of course, to our audience, thank you for tuning in as always. Make sure you check out next week's episode because we got a dividend double feature for you folks. DIY investor Henry Ma, he's written a new book on dividend investing based on his over 30 years of experience. We're going to get a sneak peek inside some of his biggest insights. You don't want to miss it. That's all the time we have for this edition. From everyone on the show, we thank you so much for tuning in. We'll see you all next time.